1 year ago, I made a decision that seemed small at the time, but changed my entire relationship with financial institutions. I stopped updating my income information with banks. Every pop-up asking me to verify my annual earnings, every email requesting updated financial information, every phone call from customer service suggesting I provide current income data. I closed them all without responding. Here's what happened. Absolutely nothing negative. My account stayed open. My credit cards kept working. My credit score didn't drop. No services were interrupted. No penalties were assessed. But several positive things did happen. The aggressive marketing from premium credit card offers stopped. The constant upsell calls decreased dramatically. My banking experience became quieter, simpler, less intrusive. More importantly, I avoided becoming a more profitable target. I stopped feeding data into algorithms designed to extract maximum value from my financial life. Today, I'm going to walk you through why I made this decision, what actually happens when you stop sharing income data, and how you can implement the same strategy. By the end of this video, you'll understand that most income requests from banks aren't requirements, they're asks, and you have more power to decline than you've been led to believe. Let me start with why I decided to stop updating in the first place. I'd been working in financial analysis for several years, and my income had increased substantially. I was earning about 40% more than when I'd originally opened most of my credit card accounts. The conventional advice suggested I should update this information with my banks to potentially qualify for higher credit limits and better terms. Then I started researching what banks actually do with income data, not what they say they do in marketing materials, what they actually do in practice. What I found changed my perspective completely. Banks use your income data primarily to make 3 categories of decisions. All 3 benefit them more than they benefit you. Category 1. Setting credit limits that maximize their revenue, not your benefit. The standard explanation is that higher income leads to higher credit limits because you can handle more debt. This seems logical until you examine what higher limits actually accomplish. Banks know from decades of behavioral data that people with higher credit limits tend to carry higher balances. A customer with a $30,000 limit carries larger balances on average than a customer with a $10,000 limit, even when they have the same income. Higher limits aren't being offered as a favor. They're being offered because they statistically lead to more interest revenue. The bank isn't rewarding your higher income. They're giving you more rope because customers with more available credit tend to use more of it. I already had sufficient credit limits for my actual needs. Higher limits would only create more temptation to spend and more opportunity to carry expensive balances. Category 2. Price discrimination based on ability to pay. This is the part that surprised me most. You'd assume higher income leads to better interest rates because higher earners are lower risk. Sometimes this is true, but often it works in reverse. Banks use sophisticated algorithms that combine income data with other behavioral signals to determine not just your risk level, but your price sensitivity. Someone earning $180,000 per year might be less likely to shop around for better rates. Someone with substantial income might not notice or care about a few percentage points of difference. The algorithm understands this. It adjusts offers accordingly. Your high income can become a signal that you'll accept worse terms because you can afford them and probably won't bother negotiating or switching. Studies have documented this practice. Affluent customers sometimes receive worse pricing than they qualify for because banks correctly predict they won't push back. Your income data becomes ammunition for charging you more, not less. Category 3. Targeted marketing and upselling calibrated to your earnings. The moment you reveal updated income, you get categorized into marketing segments. High earners receive aggressive pitches for premium cards with high annual fees, personal loans, investment products, insurance packages. Every login becomes an obstacle course of offers. Every customer service call includes upsell attempts. The frequency and persistence of marketing correlates directly with your income bracket. Banks know someone earning $160,000 is more likely to say yes to a $550 annual fee card than someone earning $55,000. They also know high earners often have more financial complexity, creating opportunities to cross-sell additional services. Your income data isn't sitting passively in a database. It's actively being used to determine which products to push, how aggressively to push them, and what prices to quote. When I understood these three uses, the decision became clear. I had nothing to gain and multiple ways to lose by continuing to update my income. Let me give you a concrete example of how this plays out with real financial consequences. A colleague of mine earned $72,000 when he opened his primary credit card 5 years ago. Last year, his income increased to $118,000. He received a pop-up asking him to update his income information to help the bank serve him better. He updated it accurately. Within 2 months, several things happened. He received a credit limit increase from $15,000 to $28,000 without requesting it. His mailbox filled with offers for premium travel cards with annual fees between $450 and $550. He started receiving calls about personal loan products at rates between 8% and 11%. 6 months later, he applied for a new credit card with a different bank. Despite his excellent credit score of 782, he was quoted an APR of 19.99%. When he called to negotiate, the representative noted his substantial income in their system and suggested the rate was appropriate for his profile. He later discovered that applicants with similar credit scores but lower stated incomes were being offered intro rates of 0% for 15 months. His higher income had flagged him as someone who could afford to pay higher rates and probably wouldn't shop around aggressively. Over 5 years, if he carries an average balance of $5,000 on that card, the difference between 19.99% and a 0% intro rate followed by 15.99% standard rate cost him approximately $2,800 in additional interest. He voluntarily provided information that directly cost him thousands of dollars. Same person, same creditworthiness. The only variable was disclosed income, leading to worse pricing. Now, let me address when you actually must provide income information versus when it's optional. Mortgage applications require income verification. This is federally mandated under qualified mortgage rules. You'll provide pay stubs, tax returns, and employment verification. There's no avoiding this, and you shouldn't want to. Proper income verification protects both parties. Auto loans typically require income disclosure, though verification standards vary by lender. This is generally necessary for loan approval and is used legitimately to assess debt-to-income ratios. New credit card applications ask for income, but here's what most people don't know. Credit card companies generally do not verify the income you report. They can't access your tax returns without your permission. They rely on stated income unless you're applying for extremely high limits. The key insight is this. Initial applications often require income because it affects approval decisions, but update requests on existing accounts are almost always optional. When your bank sends a pop-up asking you to update your annual income on an account you've had for 3 years, that's not a requirement. That's a request for data they'll use to make decisions that benefit them. You can decline. Nothing bad happens. Your account continues functioning normally. Here's my exact protocol for handling income requests. For pop-ups on existing accounts, I close them immediately without providing information. I don't click Maybe Later. I don't engage. I just close the pop-up and continue with what I was doing. For email requests, I delete them without responding. Banks send these periodically to gather fresh data. Ignoring them has zero consequences. For phone calls from customer service mentioning income updates, I politely decline. I say I'm not interested in providing that information at this time. The call ends. My accounts remain unchanged. For credit limit increase offers that require income verification, I evaluate whether I actually want or need the increase. Usually, I don't. I decline the offer. If I genuinely wanted a higher limit, I might provide income data for that specific purpose. But I do it intentionally, not reflexively. The key is shifting from automatic compliance to intentional evaluation. Each request gets assessed. Does providing this information serve my interests? Usually no. So I decline. The key is shifting from automatic compliance to intentional evaluation. Each request gets assessed. Does providing this information serve my interests? Usually no. So I decline. Let me break down the exact decision framework I use for different scenarios, because nuance matters here. Scenario 1. You receive a pop-up asking to update income on a credit card you've had for 4 years. Your income hasn't changed significantly, or it's increased modestly. Decision: decline. There's zero benefit to you. The bank already extended you credit based on older income data. Updating serves only their marketing and pricing algorithms. Scenario 2. You receive a pop-up on the same card, but your income has tripled, and you genuinely want a credit limit increase for a specific planned large purchase. Decision: consider providing updated income for that specific purpose, but understand you're trading data for limit. Evaluate if the limit increase is actually necessary or if there are alternatives. Scenario 3. You're applying for a mortgage, and the lender requests comprehensive income documentation, including tax returns, pay stubs, and employment verification. Decision: provide everything requested. This is legally required and necessary for loan approval. There's no avoiding it and no reason to try. Scenario 4. Your bank sends an email saying they need to update your information to maintain your account in good standing. Decision: this is almost certainly not true. Ignore the email. If your account actually required updated information for regulatory compliance, they would send official certified mail, not a casual email. These emails are marketing attempts disguised as requirements. Scenario 5. A customer service representative mentions during a call that you could get better offers if you update your income. Decision: politely decline. The better offers are usually higher fee products or higher limit increases you don't need. The representative is following a script designed to gather data. Scenario 6. You're applying for a new credit card, and the application requires income. Your income is variable, or you have multiple income sources. Decision: report conservatively. If you earn between $65,000 and $95,000, depending on the year, report closer to the lower end. You don't need to report your absolute maximum possible earnings. Reasonable good faith estimates are acceptable. The pattern across these scenarios is consistent. Provide income when it's legally required or when it serves a specific goal you've independently decided matters to you. Decline in all other situations. Now let me address what happens behind the scenes when you do provide income data, because understanding the full picture makes the decision clearer. When you update your income with a bank, that information doesn't stay isolated to that one institution. Most banks share data with credit bureaus, marketing partners, and affiliated companies. Your income figure gets incorporated into broader profiles used across the financial industry. Credit bureaus like Experian, Equifax, and TransUnion maintain income estimates on most consumers. They derive these from multiple sources, including credit applications, public records, and data purchases from banks and other companies. When you provide updated income to one bank, it often gets shared and incorporated into these broader profiles. These income estimates then get sold to other financial institutions for marketing purposes. That's why, when you apply for a mortgage and provide detailed income documentation, you suddenly start receiving credit card offers and investment solicitations from companies you've never done business with. Your income data leaked through the system. The more often you update your income across various institutions, the more accurate the industry's profile of your earnings becomes. A more accurate profile means more effective targeting and pricing discrimination against you. By declining to update, you're introducing noise into these systems. Your actual current income remains somewhat obscure. The industry estimates become stale and less reliable. This makes you a less valuable target for aggressive pricing and marketing. Over the past year, I've declined approximately 15 income update requests across various accounts. Every account still functions perfectly. No services were interrupted. No negative consequences occurred. What did change is the reduction in targeted marketing. Without fresh income data, the algorithms have less to work with. My profile gradually became stale. The intensity of upselling decreased noticeably over 6 months. Now, let me address the psychological element that makes declining these requests difficult for most people. Banks have trained us to feel obligated to provide information when asked. The request carries implicit authority. The form creates implied requirements. The language suggests that updating information helps you, improves your service, ensures accuracy. Most people comply because non-compliance feels awkward or risky. What if they close my account? What if my credit score drops? What if I miss out on better offers? These fears are deliberately cultivated. Banks benefit when customers feel uncertain about their right to decline. Uncertainty leads to compliance. Compliance leads to data collection. Data collection leads to more effective targeting and higher revenue extraction. Breaking this conditioning requires understanding a simple truth. Your income is your private information. Banks have no inherent right to it beyond specific lending decisions. Update requests are asks, not demands. The first time you close an income pop-up without providing information, you might feel mild anxiety. You might wonder if you made a mistake. You didn't. Nothing will happen. The second time feels easier. The third time feels normal. By the 10th time, you'll wonder why you ever felt obligated. This pattern extends beyond banking. Every institution that asks for your data is collecting it for their benefit, not yours. They frame requests as serving you better, improving your experience, ensuring accuracy. These framings obscure the actual purpose, which is enabling more precise extraction of value from your relationship. The principle of data minimization applies universally. Provide what's legally required. Provide what serves your interests in specific situations. Decline everything else. For banks specifically, this means providing income for mortgage applications where it's mandated. Providing it for auto loans where it affects approval. Providing it for initial credit card applications where you've made an intentional choice to apply. But declining ongoing update requests on existing accounts where the primary purpose is feeding targeting algorithms. Let me give you the 1-year results of this approach. I have 7 credit card accounts, 2 bank accounts, and 1 brokerage account. Over the past year, I received income update requests from 6 of these institutions, some multiple times. I declined every single request. 0 consequences. All accounts function normally. My credit score actually increased by 18 points over the year due to improving utilization and aging accounts. The volume of premium credit card offers I receive has decreased by roughly 60%. I went from receiving 8 to 12 offers per month to receiving 3 to 4. My mailbox is less cluttered. My email is cleaner. When I call customer service, upsell attempts are less frequent and less aggressive. The algorithms have less recent data to work with, so I get categorized into less lucrative segments. When I call customer service, upsell attempts are less frequent and less aggressive. The algorithms have less recent data to work with, so I get categorized into less lucrative segments. Let me give you specific language to use when banks push back on your decision to decline income updates, because occasionally they do. If a customer service representative says you need to update your income to maintain your account, here's what to say. I'm not comfortable providing that information at this time. If there's a specific regulatory requirement, please send me documentation of that requirement in writing. This almost always ends the conversation because there is no regulatory requirement for updating income on existing accounts. If they say updating would qualify you for better terms or higher limits, respond with, I'm satisfied with my current account terms. If anything changes, I'll reach out. This makes clear you're making an informed choice to decline, not simply forgetting or avoiding. If they suggest that updating helps them serve you better, you can say, I understand, but I prefer to keep my financial information private unless there's a specific need. You don't need to justify or explain beyond this. The key is being polite but firm. You're not arguing. You're not being difficult. You're simply exercising your right to keep your information private. Most representatives will note your preference and move on. In the rare case where a bank actually threatens account closure or service interruption for not providing income updates, that would be highly unusual and potentially problematic on their end. No major bank does this for existing accounts in good standing. If it somehow happened, you'd simply take your business elsewhere. But in a year of declining these requests across multiple institutions, I've never encountered anything remotely close to this. What I have encountered is persistent asking. The same bank will send another pop-up 3 months later. I decline again. They'll send another 6 months after that. I decline again. This is expected. They're optimizing for the percentage of customers who eventually comply out of annoyance or uncertainty. Be the customer who doesn't. Most importantly, I avoided providing information that could have been used to charge me more for future products. My income has increased 25% over the past year. None of my financial institutions know this. They can't use it against me in pricing decisions. When I do eventually apply for a new loan or credit product, I'll provide current income at that time because it serves my interest in that specific context. But I won't volunteer it for ongoing accounts where it only serves the institution. This strategy works because banks operate on fresh data. Stale information is less valuable for targeting and pricing. A 3-year-old income figure doesn't trigger the same algorithmic responses as a recently updated one. Every time you decline an update request, you're forcing the bank to work with older, less predictive data. This generally leads to more conservative treatment, which often benefits you as a customer. The broader lesson applies to all institutional data requests. Companies want your information because it enables better monetization of your relationship. They frame requests as beneficial to you because that increases compliance. Understanding this dynamic changes how you respond. Instead of reflexively providing whatever is asked, you evaluate each request. Is this legally required? Does it serve my specific interest right now? If no to both, decline. The cumulative effect of this approach over time is substantial. You maintain more privacy. You give institutions less ammunition for targeting. You avoid providing data that can be used against you in pricing and marketing decisions. Banks will continue asking. They'll send pop-ups, emails, and make calls. Each request is an opportunity to practice declining. Each decline reinforces that you control your information and you share it intentionally, not automatically. 1 year into this experiment, the results are clear. Declining income update requests costs nothing and provides multiple benefits. The conventional advice to keep banks updated serves their interests, not yours. The better strategy is selective disclosure based on your own evaluation of each situation. Your income is your private information. Share it when required by law. Share it when it serves your specific purpose. Decline to share it when the primary beneficiary is an algorithm designed to extract more value from your financial life.